Do you know that moment when you log into your credit card app to do the one responsible thing? Pay your bill, and the first thing you see is a pop-up that says, update your annual income to help us serve you better. Serve you better, like they're your personal trainer, but for debt. The form is always friendly, your old income is pre-filled, and the box is just sitting there like a snap. This is not customer service. This is data collection wearing a smile. Here's the uncomfortable truth. In most situations, banks are not legally required to have your freshly updated income sitting in their file. They asked because they want to know, because knowing helps them make more money from you, and the game gets easier when you hand them the numbers. So today we're doing something radical in modern life. We're separating required from requested, because banks blur that line on purpose. The screen looks official, the wording sounds mandatory, and your brain goes, well, I guess I have to. You don't. And once you see what actually happens after you type your income into that little box, you'll treat those pop-ups the same way you treat accept all cookies, which is, you shouldn't. Here's the hook. Every time you tell a bank your income, you're not updating your profile. You're refreshing the bank's strategy against you. Algorithms start running. Calculations begin. And your profile gets adjusted in ways you'll never see, but will absolutely feel. Let's break down what that number does, without turning this into a conspiracy documentary with dramatic music and red strings. Banks don't use income data for one thing. They use it for a whole ecosystem of decision. How they categorize you, what you pay, what you get offered, and how hard they sell to you. First, credit limits. Higher income usually means higher limits. Sounds flattering. Until you remember, a higher limit is not a prize. It's a bigger runway for bigger balances, which means more interest dollars over time. And banks know people with higher limits tend to carry higher balances. In other words, congratulations, you're approved for more rope. Second, pricing. Most people assume higher income leads to better rates because you're lower risk. But banks don't only model risk, they model how sensitive you are to price, how likely you are to shop around, negotiate, or switch. The transcript even points out the idea that higher income can signal you can be charged more without losing your business, and names this ability to pay pricing. A translation, the more you can tolerate, the more they'll try. Third, marketing. Income turns you into a segment. High earners get the velvet rope funnel, premium cards, high annual fees, exclusive upgrades, personal loans, investment products, insurance packages. Every login becomes an obstacle course of upsells calibrated to your bracket. Lower income customers get the other funnel, fewer premium offers, more predatory ones, and limit increases designed to enable overspending. Different outfit, the same goal, separate you from your money. Fourth, what happens when the economy gets tense? Banks review portfolios, limits get cut, accounts get closed, interest rates get bumped, and income data plays a role in those algorithmic decisions. The less data they have to sort you with, the more they have to rely on your actual behavior. And here's the part nobody thinks about: your income data sticks around. The number you typed years ago can still influence how you're treated today, and can be factored into decisions you'll never get to watch happen in real time. Banks have long memories. Your data has a long half-life. Now, before we go full delete all apps and move to a cabin, let's get practical. When do you actually have to disclose income? If you're applying for a mortgage, income verification is part of the deal. A pay stubs, tax returns, employment verification, the whole adulting package. Auto loans typically require income disclosure too, though verification standards vary. Credit cards are the weird middle ground. Applications ask for income, but credit card companies generally don't verify what you report because they can't access your tax returns or pay stubs without permission, which should immediately make you ask, if they're not verifying it, why do they want it so badly? And those please update your income pop-ups after you're already a customer. Those periodic income update requests are optional, designed to look mandatory while being completely voluntary. They want fresh data because fresh data is more predictive. Stale data doesn't trigger the same responses. Quick legal moment, because I'm not trying to build your life around bank hacks. I'm not telling you to lie. Lying on a credit application is fraud. Don't do it. The move is not fake it. The move is don't volunteer fresh data unless it helps you. Mid-video question. Have you ever updated your income because the app asked this and then noticed your bank suddenly got clingy? More emails, more pop-ups, more exclusive offers. What changed for you? Your credit limit, the kinds of offers, your spam level? Drop it in the comments, because if enough people compare notes, the "it's just you" illusion dies. Here's the framework I want you to steal. Your relationship with a bank is asymmetric. They already see your spending patterns, payment history, debt levels, habits, and use algorithms to extract maximum value. Meanwhile, you don't see their internal decision-making, categorization, or how your data changes the terms you get. So refusing to provide extra information doesn't make you invisible. It just reduces the asymmetry a little. And there's a deeper reason this works. Banks don't just look at you as a person, they look at you as a profit model, your lifetime value. Income is a major input to that calculation. And when you hand them a precise number, you make it easier to optimize against you. Refusing to help them calculate your lifetime value precisely introduces uncertainty, and uncertainty tends to lead to more conservative treatment. Also notice how persistent those income prompts are. They don't want your income once, they want it fresh. That's why they ask for updates so persistently. Each update resets the clock, and you become a newly classified target again. And here's the funniest part. The first time you close it, you might feel anxious like you did something wrong, but there aren't consequences. They'll ask again later. Your accounts still function normally. That authority vibe is mostly theater designed to create compliance. Let me give you a scenario that's extremely common. A freelancer has variable income. Some months are great, some months are ramen and praying. They apply for a card and report conservatively. 2 years later, the bank offers a credit limit increase, but only if they update income. They update it, and suddenly their entire banking experience changes. Calls about personal loan products, premium card offers, balance transfer promos, an aggressive sales campaign. Then they stop updating. And over time, the noise fades because the algorithm stops receiving fresh data. So what do you actually do the next time that income box appears? Here's a simple decision tree. First, decide what you want. Do you want a bigger credit limit? Sometimes it's useful, like if you're trying to keep utilization low while you put normal spending on a card. But remember, higher limits can enable more spending and bigger balances. Don't chase a limit increase as a status symbol. Flexing your credit line is like flexing the size of your future problem. Second, treat income updates like optional profile questions. If you're on an existing account and you don't need anything from the bank, close the pop-up. There's no penalty for ignoring those requests. They'll disappear and return, and you can ignore them indefinitely. Third, if you do want something like a higher limit or a new loan, update strategically. Update your income when it benefits you, or decline when it serves the bank more than it serves you. Fourth, on new credit card applications, provide what's needed for approval, but be thoughtful. If your income is variable, you don't need to report your best month. If you have multiple components, you don't need to include all of them. Report accurately, but don't volunteer more than necessary. Fifth, if a bank calls and asks you to update your information, remember those calls are designed to create pressure and immediacy. You can simply decline. The call ends, accounts remain open. One more practical layer, if your goal is to be treated well by credit systems, the boring moves still win. Keep utilization low, pay on time, and avoid bouncing between products because you're bored. When income is missing or outdated, as behavior carries more weight. That's not romantic advice, that's just the only part of this relationship where you control the inputs. Finally, a mindset shift. Don't treat every bank request as a task in your to-do list. Treat it like a negotiating. They're asking for something valuable. Your default should be, what do I get in return? If the answer is nothing but will serve you better, congratulations, you found marketing. Bottom line, provide what's required, protect what's optional. Data minimization is a legit strategy. Banks aren't comic book villains, but they are profit-maximizing entities that treat customer data like a resource. So don't feed the machine fresh numbers unless you're getting something you actually want. Next time that pop-up appears, you have two buttons. One says update income, the other says close. One helps the bank recalibrate its profit model. The other helps you keep your financial life boring. And boring is underrated. And watch the brutal math behind $500,000 starter home. Because nothing motivates minimalist budgeting like realizing approved doesn't mean affordable. Scroll, consume, repeat, but maybe, just maybe, don't repeat the part where your money disappears.